Hello, everybody. My name is Alesh Eisner, and welcome to the Canadian Money Talk. This is my friend Rob from the Mindful Investor. As always, we are going to entertain you with a lively discussion about the difference between dividends and option selling. So it's going to kind of summarize what we had talked about previously. So welcome, Rob.
Yep, thanks for having me again. Yeah, I'm looking forward to this podcast.
What we wanted to kind of do a compare and contrast regarding getting cash flow from dividends, which we talked about on our first podcast, and then getting cash flow from options. So I think both Rob and I go about it in a different way. So we just sort of wanted to talk through it and then have a discussion. So Rob, let's start with you. How's dividend stocks and option selling been for you?
Yeah, I think we just treat them as active and passive. Like in my opinion, I think dividends is all passive. I even have to look at it for quarters even. Sometimes I think I just log into that account on a monthly basis just to put money in and just buy some stocks and then log out. That's all I do. There's no selling, you just buy and just let it fly. But for selling premium, like option premiums, yeah, you have to be pretty active. You have to spot like stock price volatility, like how and why things are like swinging, and if it makes sense or not. If it doesn't make sense, then you kind of act the other way and collect some premiums. Or if I'm holding a lot of solid blue chipper stocks, I tend to do covered calls and collect premiums that way. So that strategy, you definitely need to be a lot more active, at least once a week, or maybe just 5 minutes in the morning. You see what's like, you see your top 10 picks or top 10 holdings and see if anyone are like swinging 5-10% even. And then like if that's the case, then it's worthwhile to take a look at like making some moves, because collecting premiums is all about volatility, and that will get you a lot, some more, eke out more profits for you.
Mm-hmm.
Yeah.
Mm-hmm. So, I mean, you may need to make adjustments on the fly as well if you've sold something and it's going in a direction that maybe you weren't expecting. You end up having to make transactions at that point.
Yeah, and sometimes you do the short put, and then you get a little bit greedy, and you sell more contracts, and you ever want to hold. Then you just have like, I don't know, 1,000 shares of some weed stock, and continuously go down. Then what? You're collecting a couple $100, but you're losing thousands, right? So yeah, like the you need to be you need to know exactly what you're getting into, like if you actually really want to hold the stock or not, or you're just there to collect the premiums.
Mm-hmm.
Yeah.
But so on an individual trade, uh, there is the risk that you could actually be cash flow negative once you collected the premium and then you've had to buy something back, for example.
Yeah, as for compared to dividends, you can't yeah, you go negative dividends, right? you,
Right.
the worst that can happen is zero. They can cut the dividends, but 90% of the time it's just continuously just it's just steady growth payouts for me.
Right. Yeah, I think my approach is similar. So for the dividends, I'm just buying dividend stocks and uh, looking forward to the dividends when they start coming in next quarter or whenever they start. But of course that requires a lot of capital upfront. While with the options in a margin account, I don't need to have any cash on hand until I actually receive the stock if I'm doing puts, or I mean if I lose the stock to covered calls, then I actually end up getting cash. But I guess the point is you don't need quite as much capital with options in order to be able to get the premium, as long as you're right in the direction.
Yeah, yeah. For dividend stocks, you just have one direction. Like you just want it to go up, but it doesn't have to go up. It can stay flat because you don't care about the stock price really. But for options, you have to care about the stock price. Like
Right.
that's all you care about.
And obviously, the more volatility, the higher the premium. And so what sort of stocks then do you look for with dividends? It sounds like you're more blue chipper, but with options, do you look for the volatile ones in order to collect more premium?
Yeah, usually, but I have made plays on these blue chip stocks. Let's say Enbridge, the pipeline stock. I went for the U.S. market because there there was actually a market in the for that in the U.S. counterpart, and for that one, I I think I made a video of it, and I bought the stocks first. So I bought a chunk, and then I play within that chunk. I just sell the call and the put at the same time, and I just churn away the premiums. And if nothing happens, then I collect the dividends as well. So it makes sense for me. It's like winning in three different ways, possibly. And let's say if the stock does hike up 5-10%, and somehow I lose some shares, like that is capital gains as well. So I'm winning four ways, possibly. Like that, like you can make these plays for pretty much any stock. And on the other side, I have the tech stocks, which have like Teslas. I tend to sell calls when things get like a little bit overhyped, and when people get like fearful when it dropped like from $900 to $600. I sold puts for $300. That's when people got fearful, and I collected premiums there too.
Okay.
Yeah.
So going back to your first example, which sounded like it was the most interesting, you I believe it's called a short strangle or short straddle, where you sell both a call and you sold a put. So if the stock doesn't move, you just get the premium. Everybody's or you're happy anyway. If the stock goes down, then you get more
More
of
shares.
that
Yeah.
stock, and then of course you'll get more dividends. If the stock goes up, then you lose. I'm assuming only some of the stock, um, and but you've been collecting dividends all along as well. So there's that.
Yeah, and so even if it stays flat, I'm making money
Yeah.
like three ways. If it goes up, only making the money maybe two ways. Yeah, so it's but that requires some attention as well. It's not just set it forget it type of thing. Yeah,
Well, it
it's more
depends.
complex. Yeah,
It depends whether you want the stock or not, I suppose.
yeah,
Okay.
exactly.
So is that one of the more successful ones for you that you're kind of making money multiple ways, but you're also having to look after it a little bit more?
Yeah. This is something new for me. And to add to that, I actually used margin and I doubled my position because my margin rates at Interactive Brokers was only 2%, but this Enbridge paid out like 7% back then. So I just doubled it and it made sense for me.
All right. So it sounds like you take some risks as well along the way.
Yeah. I went for some leverage for sure.
Yeah. Should do a public service announcement. Using margin accounts will increase your risk profile.
Yeah, and also increases your returns too.
That's true. That's very true.
Yeah.
Okay, well, I mean, that's quite the strategy, and it sounds like it's producing good cash flow for you.
Yeah.
Okay, well, excellent. I use something very similar, so I keep buying, like I said, with the uh, with the options. I do mostly cash covered puts on stocks that I don't mind getting. And if I do get it, great. If I don't get it, well, then I collected the premium, and that was fine. What I do like though is that with options, you really don't need any capital upfront until you possibly get that stock. So you could be making a 20-30% annualized return off of nothing. If you have a margin account where I have the purchasing power to cover the put, but I don't actually have to supply cash until uh, if it actually does happen and I get the stock. So I'm making 20-30% off of nothing, which I love. Um, but yeah, with the dividends only make 3-4%. That's the thing. Uh, and so I actually do like the options. Now, having said that, I'm still wary of them, and I don't go all in. So I think the most exposure I've ever had was about 60K. But so far I've collected in the 9 months I've collected about 17,000 in premiums. So yeah, not bad. And I've got a few stocks, of course, along the way, which then I have to finance. But it I think it turned out okay. Um,
Yeah, and another strategy is like you mentioned when the expiration date comes, like when you're like the options in the money and you're kind of forced to buy it.
right.
Like there's a strategy to like roll it away. Like you actually push the date back a month or two. Like if you see it going like towards you, like going against you, you can push it back. So 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 you just move the date back and then you just hope that the stock will eventually taper and bounce back the other way.
Well, so you mean you buy it back and then you put out another one?
At the same time, yeah,
Yeah,
it's called rolling options. And it's
right.
a really common strategy when people don't want to own the stock. They just want to make that play and they think that over the medium term things will go towards the way they think it will.
But ultimately, you have to produce a whole bunch of cash, and it'll well because the option price has moved as well along with the stock, right? So in
Um
order to buy the option back, you're basically paying the difference between where the current price is and where the strike price is.
yeah, but it's a tiny amount. You're not forking out the whole position. You're just forking out the premiums. And then when you sell the next one, you kind of collecting it back right away. So you putting $1,000 to buy to settle the position, but you're selling $1,000 out, so you're getting the $1,000 back. So it's pretty much net zero.
Well,
It's
maybe
complicated, but yeah.
no. But at least in what I've seen, the options price went up significantly as well as it became in the money, and eventually becomes one for one. Once it's far enough in the money,
When it's far enough, yeah.
then
That's
it
why
becomes
we
one.
need to kind of act before that happens. Is it like
Right.
it's heading towards you? That's when you kind of make a move.
Yeah, and so that's
Yeah.
where, to your point, it's quite active, and
Yes.
you sort of have to watch it, and
Yeah.
you're like, do I believe the stock is going to go the other way in my favor, or is it going to get worse, and I need to pull the trigger now?
Yep. Exactly.
Uh, but yeah, I still found myself, collecting $300 in premium and then having to shell out a couple of thousand in order to buy it back because the stock just did something crazy.
Hmm. Okay.
I also I think mine is less liquid because I trade in the Canadian options. So I think
Yeah.
there's also something there that I'm only dealing with the market makers while you're actually dealing with traders that are doing the same thing you are. So um, yeah, I mean there's definitely risk with options. It's not the holy grail of investing. There's pluses and minuses. You get better returns, but the risk is there as well. And yeah. I mean, I found that I have to watch it as well, even though I've never bought one back. I think as we talked about previously, nor yeah, I've never bought one back. I've either let it expire worthless, or I lost the stock, or I got the stock, which saves me on transaction fees perhaps. And if I got a stock that I was only half happy with, then I would end up selling a covered call, in 3 days afterwards. So, but yeah, it's a lot more active. I mean, it's not like day trading, but you do have to watch it a little bit, I guess, right?
Yeah, yeah, it's not for everyone.
Thank you very much for watching the podcast. I've been Alesh Eisner from Canadian Money Talk, and this has been Rob from the Mindful Investor.
Thank you.